Hello, everyone. Welcome back to another episode of the Integrating Investor. I'm Seth Levine of the Integrating Investor. Thanks for joining me again. Hang on one second. Oh, just playing with my audio settings. You'd think I'd have it down by now. But thanks for joining me again. I hope you all had a great holiday break. We did break for Thanksgiving here. I have a long show planned for today. We'll see kind of how far we go. I'm gonna try to move quickly, but maybe not, because it is a pretty big topic. So if we're running long, I'll maybe break this up over 2 weeks. But along those lines, I am going to wrap up what I'll call season one of the Integrating Investor, either next week if we get through today's material, or the week after if this goes a little bit long today. I think we've covered a lot of ground this season. I'd like to just take a step back, reflect on kind of what we discussed, and just see where we could take it from there. As always, please like and share this show. Really help me get the word out. Really appreciate it. You could just hit that thumbs up button right there. It's just waiting for you. It's smiling at you. Hit it now. And then, if you don't like it at the end, you could just unclick it or thumbs down it or, whatever. But this way, you don't have to remember. It's always helpful for me. You can follow me on Twitter, Instagram to a lesser extent. And of course, you can check out the website, sign up there to subscribe for my monthly emails, and you'll get those right in your inbox. And as always, there is the super chat function. Appreciate everyone using that just to get my attention. I do like to make these as interactive as possible. And you can email me show topics or guest suggestions at info@integratinginvestor.com. That's info@integratinginvestor.com. And today you may want to particularly get on that, follow me on Twitter, because I am in the middle of another cook going right now, which is never smart to do on a Friday, but something I always plan on doing. I'm cooking up some, trying my hand at some barbecue pork belly. I've never done that today, and I threw some ribs on there for some good measure. So fingers crossed we'll be eating dinner at a reasonable time today. But as with barbecue, I mean, there's no guaranteeing anything. So that brings us to my favorite part of the show, the lovely disclaimer. Of course, these are just personal opinions and not investment advice or recommendations to purchase or sell any investment products or services, nor should you rely on anything I say for investment decisions. Today, particularly, I'm going to be discussing gold, and I do own and control accounts that have gold and gold-related investments. So, keep that in mind, I guess, when we're going through everything. So, as I just teased, today's show, we're going to talk about gold and inflation. As the title suggests. And specifically how gold isn't as good as an inflation hedge as it's popularly believed. And this is something that actually I found quite surprising, because I am, as I mentioned, is something that I own. Before we even start, we got the super chat lighting up. Thank you so much, everyone. MA, thank you again. Jonathan, thank you so much for the donations and your question. Buy, sell, or hold commodities as an asset class? Well, let's see. So, I would say commodities are a valid investment choice, right? And what is an investment? We've kind of covered this on the show, and I like to rethink everything. An investment is really just a way for you to make money by using money. And certainly you could buy commodities either in physical or financialized form. And it is possible to make a lot of money by using that money in a speculative manner. And I don't mean that, I'm not using the word speculative pejoratively. Speculation is really every investment that we make is a speculation on the future. And in fact, almost every action that we take as human beings are speculation on the future, right? And that's a big topic, that can of worms that I will not open here. But yeah, so I think it is whether or not you invest, trade commodities is an individualized decision. Certain products are better than other products. I have certainly dabbled in the past. As I said, I am dabbling currently, but I will not. I don't want to give. I don't want to wade into the investment advice arena. So hopefully that helps. That helps you, Jonathan, and let me know if not. Happy to follow up. So anyway, back to so yeah, thanks for the super chat, folks, and back to the show here. So gold and inflation. So I love this topic of gold and inflation because both are concepts that carry just a ton of baggage. They're very emotional, both gold and inflation. And because they're emotional, and because they're long-standing emotional concepts with very long histories, right? Investing in gold and inflation have very long and documented histories in investing and economics. Because of that, they're prone to mistakes and rationalistic thinking, right? Both gold and inflation are prone to mistaken and rationalistic thinking. And part of that is because they've played very different and changing roles in economies over centuries. So in order to kind of tackle this question of gold and inflation, we need to really ask ourselves, what's gold and what's inflation, and hence, can gold hedge inflation? So we can start with, what is gold, right? Is it money? Well, if gold is money, that even opens the question of what is money, right? And I did a 7-part series on that. And I think I have a little bit of a different view, at least versus the mainstream, on what is money. So I encourage you checking those out. And also, what is inflation, right? Inflation is a foundational investment, is a foundational concept in investment frameworks. And really few question what is inflation. And again, I've done a couple episodes on that as well. So my view on inflation is different in that it's changed over the years. So getting back to gold, since we're talking about gold here, inflation, I think I've beaten to death pretty handily, but haven't really touched upon gold. I touched a little bit upon gold in some of the money series. And I did it there because gold is really often thought of as money, right? What is gold? Is it money? Is gold, is it a store of value? Is it the ultimate store of value? Is it financial freedom, right? Is gold a way to protect your assets or your wealth or your stored production from kind of thieving governments who are looking to inflate away your value for their own usage via inflation? Or is gold just a shiny rock with some kind of inflated, emotionally driven price, right? Is it an irrational value trap, as a lot of people actually think? So when we think about gold, at least from an investment perspective, it's probably most commonly used to hedge inflation. And I'm going to use inflation as it's used colloquially in the investment markets today. So when we think about inflation, right, or the CPI rise, gold is not really as effective a hedge as many think. And really, this has to do not with anything with gold per se, but really in changes in the monetary regimes that lessens gold's ability to hedge inflation. In other words, our how our monetary regimes changed over the years, how we defined money, really has changed gold's ability to hedge inflation. So to sum it up, when we think about gold and inflation, this is today's theme right here. Inflation. This is not the inflation hedge that you're looking for, right? Great Star Wars meme to start. So gold's reputation as an inflation hedge is pretty well steeped in history. There are countless accounts throughout history of monetary debasement by kings and emperors and, really governments of all stripes, which routinely looked to their currencies as means to fund their expenditures. So rather than raise taxes, sell assets, or even plunder foreign lands, governments stole their desired wealth for wars, palaces, pensions, and, all sorts of bribes, directly from their citizens and creditors via inflation. So here is probably one of the most famous examples of what we will call inflation via a monetary debasement, right? Using the monetary debasement use of inflation. This is a chart from Wikipedia of the Roman denarius. Right, the Roman denarius was, probably the kind of main currency of the Roman Empire. What we can see here is really what started off as a nearly pure silver coin under Nero in like 64 AD, if not before. It was, basically debased to the point where, by 300 AD, I mean, there was just 5% of silver left in that coin. It had been diluted with other non-precious metals. Where did those precious metals go? Well, the sovereign, right? The Roman emperors kept it for itself rather than take the silver and put it into the coins. Well, they just stole it essentially. And we have other examples of monetary debasements throughout history as well, right? So the Roman denarius is a famous monetary debasement, but what happens with the US dollar under the gold standard? Let's put aside fiat currency for a moment, but the US dollar was under a gold standard for a long period of time since the founding, more or less the entire time, with a few interruptions along the way. But under FDR, for example, the US dollar was devalued by 40%, right? Prior to FDR and the Gold Reserve Act of 1934, I believe, 20.7, 1 ounce of gold was defined as $20.67. Right, so 20 2/3 of a dollar was defined as an ounce of gold. Well, FDR took that 20 and change definition and he devalued it such that $35 now equal the price of gold. Right, so he lessened the value of a dollar in terms of gold. It now took more dollars to buy an ounce of gold. Of course, there are lots of other examples too, especially in that post World War II time period. Post World War I time period in between the two world wars. Now, each of these inflations, whether it's the US dollar, whether it's denarius, whether it's any other instances of monetary debasement over time, each of these was theft. Right? There's no two ways around it. Sovereigns stole precious metal from circulation to use it for their own purposes. Now, fortunate enough citizens, right, those citizens who are fortunate could somewhat protect themselves by owning the precious metals that comprise of their currencies. By doing this, the metals were a perfect hedge against monetary debasements. Now, the metals were a perfect inflation hedge, and I'll use kind of inflation and monetary debasement a little bit synonymously here. Metals were the perfect inflation hedge for a reason, right? It was a very specific reason why the precious metals worked so well. And it was because that the precious metals actually comprise the currency's values for which people were actually trading. So people weren't necessarily transacting with denarii in the Roman Empire, so to speak, but rather the silver content within it. Right? Under the gold standards, people weren't really using US dollars per se for transactions, but rather they were trading the gold value equivalent of those dollars. Thus, when you reduce the currency's metal content, or changing the convertibility in terms of more modern times, you lowered the value of the currencies, not the value of the precious metals. Right? The currencies, in fact, were debased. A dollar was worth less in gold terms. The price of gold per se didn't necessarily change because that was kind of the implicit monetary standard. Right? When we had currencies that were comprised of metal, the real value of the currencies were not the currencies themselves, but really the precious metals that they stood for. So people were measuring economic value in terms of currency still, not necessarily in terms of the monetary metals, not necessarily the currencies. And that's just not the case today, right? We live in a fiat currency world, and there are no monetary standards. So when we think about inflation today, inflation has changed its definition, right? We live in a fiat currency world. So when we talk about inflation today, what we really mean is change in the CPI, right? Consumer Price Index, or some equivalent of it. There are a lot of different metrics, the PPI, the PCE, whatever you wanted to call it. But I just use CPI because it's easy. So when we look at how gold today, or the price of gold, hedges against changes in the CPI, aka inflation, what we find is that gold does a pretty poor job of hedging it. So this is a chart of the changes in the price of gold versus change in the price of CPI from April 1969 to October 21. So just last 2 months ago, I guess, at this point. What we see is the correlation is pretty weak, right? The R squared is just 0.175, right? You would expect a much better R squared or correlation factor if gold was actually a really effective hedge. And it's just, unfortunately, it's just not. Furthermore, what we find, and this is just looking at the time series of those two charts here. So the change in CPI is in gray, the change in gold price is in red. What you see is that gold's price change is just far more volatile than the change in CPI. Now, what you would expect is that if gold was a good hedge, they would be more similar, at least. These are vastly different, and they would correspond to each other better. Again, these charts look completely separate to me. Now, there's another wrinkle to the whole inflation, the whole inflation idea in today's economy, in today's markets. We have this idea of inflation expectations. And what an inflation expectation is, it's the market's expectation for inflation in the future. So it's acknowledging that, inflation or CPI can move around on a monthly basis, daily basis, even yearly basis. But what we're really interested in smoothing out, right, the long-term trends of inflation. So we have this concept of inflation expectations. And how, we kind of view inflation expectations is through the lens of either of government tips, right? Inflation protected securities. And we kind of use that and we look at what's called the break-even inflation rate. So we could look at it either a 5-year basis, a 10-year basis, 30-year basis, even in the US. And I have those here. Right, the green line is the 5-year tips inflation expectation. The red line is the 10-year inflation expectation. And what we find is that, the gold's price, just look at how this is not the change. This is just gold's price in absolute dollars. It really has nothing to do with the market's expectations for inflation. Now, this is all pretty puzzling, right? How can gold be so disconnected from inflation? Right? Historically, we know gold was able to protect you because it was because of the currency standards of the day. So why is our modern experience so different than the historical one? Well, I've hinted at it a bunch of times. And, I hope, all you faithful listeners out there could kind of hint why. And the reason why, in my opinion, is definition changes. The definition for both money and inflation have changed over the years. And I've showed that in prior episodes. And because of the change in definitions, the way how we talk about them today is not the same as the way how we used to talk about them. And again, I did a 7-part series on money, right? Then that started on July 9th. I did 2 shows on inflation on July 4th and 11th. And you could go back to there and see how the changes for both changed over time. And because they changed over time, gold's relation to both money and its relation to inflation, and specifically its ability to hedge inflation, has changed. It is no longer the same context as it was historically. Definitions matter. These are not just things that we ruminate on, right? Definitions affect our investment portfolios. Money. Right. So, and again, just I guess specifically here, money, let me say, money's definition changed, right? It went from a objective definition to a fiat currency standard, right? Which is no standard or subjective even. And inflation, definition of inflation went from this kind of a debasement of that monetary standard to really a redefinition of just change in a basket of prices. All right, MA, thank you again for the donations here. Really appreciate the super chat. And you're right. Okay, so CPI isn't representative of the economy, is it? So this is a big debate, MA. CPI isn't representative of the economy. So the CPI is a defined basket of goods that is set by, for CPI, I think it's the Bureau of Labor Statistics, Don't quote me on that, but I believe it's pretty close. And that is defined. Yes, that is defined by bureaucrats. And there's always a debate of how representative CPI is for the average person. I think what's so interesting about CPI versus a monetary debasement is, in my perspective, who cares about the CPI, right? Who cares about the average spend of people, right? In America, there's 350 million people, there's billions of people on earth. No two people are going to be the same. How relevant is the average spend, to each person? Now, what's so interesting about inflation as a debasement of a monetary standard, as opposed to debasement as a change in some kind of average, is that when we debase a monetary standard, right? So when we change the value of a dollar per se, or for example, that affects everyone, right? That effect doesn't matter, how much, what you spend your money on. However, if we look at the CPI as a measure of inflation, people feel the impacts of CPI differently, right? If you spend, for example, if you're a renter versus a homeowner, for example, your difference in your sort of CPI impact is going to be different, right? What you eat is going to be different. How much you eat out versus how much you eat home is going to play a big difference. And also with the CPI, the CPI for specifically is a very heavily adjusted number. Right. So there are these hedonic adjustments that people bemoan all the time where, we are adjusting prices to try and make things like for like, right? A car in 2021 is really not comparable to a car in, 1921, for example, right? They're totally different products. Now, the price, the sticker price is completely different as well. So we're trying to adjust and say on a sticker price equivalent basis, how do we make the car in 2021 with, safety standards, right? There were no airbags or seatbelts or anything in 1921, 100 years ago. Airbags and safety standards and electronics and gas mileage and just speed. How do we put these on a like for like basis? And there is no real way to do it, but people do it all the time. So anyway, that was a little bit of a rambling. We are just coming up on 27 minutes here. I've got about 10 more slides. I think this may be a good time to kind of end it, wrap it up, and I'll pick up next week. I was hoping to get through another bit of it, but I'd rather kind of make it short and sweet than ramble on. So I hope we're starting to see and hint at kind of why gold doesn't really hedge inflation well. And because gold's relationship to money has changed and our definition of inflation have changed. And a third thing, our monetary standard has changed. So with that, again, please, didn't mean for this to be a tease, but I guess it's going to be a bit of a tease of a show. If you're interested in this journey, if it sounds interesting, if you're going to join us next week, go ahead and hit that like button. And speaking of commodities and pork bellies, I am probably going to get back to mine. And with that, I hope you guys all have a great weekend. And we're going to pick up with this monetary standards and fiat currency and gold and inflation, and just really show why gold can't hedge against inflation as effectively as it used to. But also that doesn't mean gold is necessarily worthless. So wrap it up there and have a great weekend, everyone.